Good morning, Port St. Lucie. Welcome back to another episode of PSL Daily Download, your first stop to all things real estate in Port St. Lucie. My name is Jaime, and today is April 16th, 2024. Happy Tuesday. Today, we're going to get your day started with all things real estate. We'll go over inventory rates. We'll touch on the market. I'm also going to do the basics of understanding the yield curve conversion, and why it's important and why you may have heard about it, either in social media or on the news. But we'll get to that here in a minute. We'll keep it short, simple, educative, and hopefully a little bit of fun for you. All right, so let's get our day started. So inventory, what happened last night or day over day? The inventory in Port St. Lucie, again, my tracker from realestate.com excludes anything that's pending and vacant land. All right. So it looks like inventory has come down over the last couple days. It went from 2239 to 2233. It's actually month to date, it's at 0.5% up, but that's actually been coming down. It started off, increasing, but that slowly have been decreasing. Where we have seen increases are on properties listed under 375. So what that makes me think is that there are buyers that have finally wanted to come off the sidelines and maybe upgrade to a bigger home, and they're putting their smaller home on the market. So that month to date, it's actually increased 8.74%. You can see it down here. Properties over 375 are down 1.85. Properties listed that are currently showing reduced is up 6.16 month to date, and overnight it actually just went up a little bit of 0.47% from 635 to 638. Now, properties listed for rent decreased just a little bit from 377 to 375. Now, that has also increased month to date quite a bit, about 9% from start of 344 to 375. So we're definitely seeing some movement there. On this chart over here, you really can't tell. It's kind of a flat line, but any movement that happens over the month will start, and especially any major movements, we're going to start seeing it on that chart. So make it easier to visualize those changes. All right, so we're going to go into Mortgage News Daily's daily rate survey. Again, this is not the rate you're getting or the rate I'm offering, but this is a survey of lenders that they follow. So we'll dive on that. The 30-year fixed rate, they have it at 7.44. Again, as of end of day yesterday. That is up 0.14% from the start of yesterday. The FHA 30-year, they have it at 6.86, and that is up 0.16%, again, as of yesterday. Okay. Now, I did get some updates from lenders, and I don't have like the basis points. I really didn't get into it too much. I kind of went through it real quick, but it looks like the rates did increase, okay, from yesterday to today, at least to start the day. All right, we'll go to the market again. My favorite chart here is the CNBC US market chart. And we could see, again, it's kind of a mixed tree here. Green, red, green. Let's go to what pertains or what affects the mortgage industry, which is the U.S. 10-year Treasury yield. They have it at it's at 4.659, an increase of 0.033, and you can see it changes as I speak. So an increase there. As the yields increase, mortgage rates tend to follow that. So we'll keep following that to see if it increases quite a bit and maybe have an inter-day change. Okay. All right. So nothing there that really catches my eye. Now I'm going to go over treasuries and the yield curve. Okay. And why it's important, what you may have heard about it. But this is the basics. And again, I'm not a financial advisor, but this is for you to kind of understand the rough understanding of how it may affect us. What's the normal? Where are we at today? And why is it important? What has this, indicated in the past, right? Or preceded? And I'll show you that here in a second. So these are the U.S. Treasury yields and we can see where the 1 month treasury yield is at 5.38. And then it continues to extend in time, right? The 1 month, 3 month, 6 month, 1 year, 2, 10, and 30 year. All right. The mortgage industry tends to follow the US 10-year treasury yield because that's the closest to how long people generally keep their mortgage, which is in essence about 7 to 8 years is the average. And it's been like that since I've been in the industry. All right. But here's the weird part about the mortgages. If you are looking for a mortgage and you ask for, if you get two rates, a 15-year and a 30-year, those tend to always have a lower rate on the 15-year mortgage, right? Than a 30-year. That's why somebody would get a 15-year, like, hey, I'll pay a higher payment, right? Put it into a 15-year, but I'm going to save money on interest. My interest rate will be lower. That's normally, right? So the longer the term of these yields, the riskier they are. Just like mortgages, 30 years, it's a riskier. So those rates tend to be higher. What do we see here though? 1 month, 5.382. 30-year, 4.766. It's inverted. Shouldn't be like that. This is not normal. All right. So we'll look at the 1 month yield, and it's at 5.382. 3 months is 5.384. And again, these should be increasing substantially from one to the next. Okay, at least on the long range, right? Especially when you get into the years. 6 months, 5.369. 1 year, 5.19. 2 year, 4.953. 10-year, 4.657. And the 30-year, the longest and should be the riskiest, is actually at the lowest rate, is paying the lowest yield, which is at 4.76. This is what is known as the rates are inverted. So most of the time you'll see where they'll compare financial advisors or the news media or social media or whatever. They'll compare maybe like the 1 month or the 3 month compared to like the 10-year or 1 month and 2 year. And again, longer should be higher rate. This is the contrary. Why is this important? I'm going to go over here. And I got this from Game of Trades website. Now, there's a bunch of websites. You just Google yield curve inversion, you'll get a bunch of these. I just like this one because it's nice and clear and clean. Not too much information outside of what I just wanted to touch on. So this is the inversion. Again, going back to 10-year. Remember what I mentioned? They'll compare the long end of the curve with the short end. So the 10-year yield compared to the 3 month yield. Again, the 3 month yield should be lower than the 30-year. And normally that's the case. So anything above this line is normal. This is the normal where the longer the rate, the longer the term, the higher the rate. But you'll see in history, it inverts. Now, why is this important? This is important to track, as normally, and you can see going back to 1969, it usually an inversion precedes a recession. Again, does not mean that a recession is coming. This is one indicator of probably thousands of indicators out there. Let it be GDP reports and things like that that may indicate the market turning. But the yield curve is one of those that are highly followed by analysts and economists and financial advisors to kind of know where the market is at that time. So if we go back to 1969, you can see where it inverted, and shortly thereafter, the gray bars mean a recession. We went into a recession. Same thing in 1974. Preceded, went into a recession. In 79, actually went in a few times, it inverted a few times, then went into a recession. In 1989, exact same thing. Now, here in 1995, and I think this is 95 if I'm not mistaken, because I hear that quite a bit, it inverted, and you can see it quickly re-inverted and then kind of went up and then re-inverted right back down, uninverted, yeah, inverted. And then shortly thereafter, that was a recession. So it doesn't mean that every time it inverts, a recession is going to happen. That's not the case. As we can see here, and we'll see again in 2000, maybe 7 or 8. It reinverted. It inverted in a recession. 2019, it inverted recession. Again, that was for the pandemic. And then now we're inverted. So the biggest question is, does this mean we're in a recession? No. Does this mean that we're going to be in a recession? No. This is just an indicator to follow along with a lot of other indicators out there. But what it does tell you is that we're on the non-normal side of yields on interest rates. Okay. Now, the important thing to know is that the recessions generally don't start when we go into an inversion. So meaning we are currently right now in an inversion. Now, this chart here is not up to date. It actually goes further out. As of this month or maybe last month, we are now on the longest term recorded, if I'm not mistaken, to be inverted without reinverting. So we're kind of sticking down there. It's just, and again, maybe this time is different. There's so many things that go into this, but so we're still inverted. Okay. Now recessions don't start when we're inverted. They start when we reinvert, meaning when we get out of this inversion. So if we see here, again, this is, and I don't know if you see here, but in 1969, you can see where it went up, recession. Where it goes up is where, generally speaking, the recession starts. Shortly thereafter, it could be immediately, maybe a trigger. But it could, if we look at the 1989 chart, we'll see where um, it it took a little bit here. 1989, it happened, in 89, but it took a little bit for us to get into recession, right? But again, it was under reinversion. Same thing here. We were inverted. When we reinvert, recession. We inverted, all good. Reinvert, recession. 2019, we inverted, no issue. March of 2020, of course, because of the pandemic, inversion, recession. Sorry. Currently, we're inverted. Are we in a recession? Absolutely not. There's no indicator that says that we're in a recession right now. As a matter of fact, inflation's going crazy and prices are going up and the market's doing well. So there's nothing telling us we're in a recession. But what we're going to keep an eye on is if it reinverts or when it reinverts, because that's the trigger. And, there's a lot of other indicators. So anyway, I wanted to make sure I kind of touched on that. I've had conversations regarding the, sorry about that. I'm not sure if you saw that. I've had a lot of conversations regarding the yield curve over the last 2 years, and it's been inverted for that long. I mean, it's pretty crazy. I've never seen. I personally, obviously, you can see in the history, it hasn't happened. It being inverted this long, especially as me being a professional in the mortgage industry. So we'll keep an eye on that. Hopefully, you got some value. Hopefully, you learned something new. Of course, again, I'm not a financial advisor. I recommend if you want to dig more into that. There's 1,000 articles that are written by a lot of people a lot smarter than I am, and I encourage you to learn a little bit more about that. So, other than that, I hope you have a great day. Hope you found some value. If you did, please don't forget to click the like and the subscribe button, and I'm going to catch you on the next one.